Hi, everyone, and welcome to our webinar on being the bank with a self-directed IRA. My name is Larissa Green, and I am joined by my colleague, Renika Lateborn. We're going to be discussing today the rules for investing when you're lending money, so when you're a private money lender through your 401k or IRA, how that works, and also the strategies and process behind making those types of investments. So we're super glad that everybody could join us today. A couple things we want to make you aware of is we do have everybody on mute. That simply just makes it a little bit cleaner for the recording and also gives us the ability to share that recording at a later date. However, we do allow you to ask any questions, so just type them into the chat box and we can absolutely answer questions as we go. We'll be checking the question box or chat box often, so you can let us know if you have any questions as we go through the presentation. The first question that popped up is, can we share the presentation later on? The recording will come to you guys once it's available, so in just a day or so you'll get the recording. And then if you'd like a copy of the slides, just please email us and we will make sure that you receive a copy of the slides later on. Unfortunately, it can't go out in the email with the recording. There's just not a good way to do that, but you certainly can request them, and our contact information is on the next slide. Again, as I said, my name is Larissa Green. I have been with Advanta IRA a little under 10 years, and I've been doing business development and education for about 8 of those 10 years, and I've really enjoyed my time at Advanta. I have learned a lot about different investment strategies investors are using, and I have also really enjoyed getting out there and meeting you guys in the investor community. So many of you on today, we have met in person at classes and seminars, and it's been a lot of fun. And again, I'm joined by my colleague, Renika Lateborn, and I'm going to let her introduce herself. How are you doing today, Renika?
Hi, Larissa. I'm doing well. How are you?
Good.
That's good. Welcome, everyone. Again, we're thankful to have you all joining today's webinar. Like Larissa mentioned, my name is Renika Lateborn. I'm one of the business development specialists here in the Atlanta market. So our headquarters is in Largo, Florida, but we do have an office here in Atlanta. I've been with Advanta for a little over a year and a half now, but I'm also an active self-directed IRA investor. I'm actually a client of Advanta prior to joining on as an employee. So today we're going to be talking about private lending, the different options available to you. I've had the opportunity to actually use my my self-directed IRA to invest in private lending. So this is one of my preferred strategies. So I do want to give a quick disclaimer before we get started. At Advanta, we don't give any tax, legal, or investment advice. We don't endorse any particular products. We do want you to know that all of the information that we present today is just educational purposes. So you are encouraged to do your own due diligence. Definitely consult with your professional team, like your attorney, your CPA, or financial advisor. If you're relatively new to self-directing, or maybe you're just revisiting the concept after some time and you're doing your due diligence, it can be a lot of information all at once. But the 3 key points that we want you to take away from today's webinar is, first and foremost, know that any IRA or former employer plan that you have, like a 401k or 403b, qualifies to be self-directed. With self-directing, you're in control. You actually choose the investment that works best for you. In a private lending scenario that we'll kind of cover today, you would actually go out and find the borrower. So if you're part of, say, a local RIA group, or it's part of your networking group, you would go and find the borrower, or maybe work with a mortgage broker to connect you with a qualified borrower. And then the third takeaway is just know that all of the income and the profits that's generated from the investment will flow back into your IRA at tax-free or tax-deferred, just depending on the type of account that you have. And we'll look at the different account options as well. So in addition to diversifying your portfolio, because you have the ability to invest in so many different assets, of course, building retirement wealth, investors like the option to invest within a self-directed IRA, just because, again, the tax liabilities, having to deal with any tax liabilities personally.
A little bit about Advanta, and I don't think we mentioned this, but just to give you an idea, I'm in the Tampa Bay area of Florida, and Renika's actually in Atlanta, Georgia. So we have two separate offices, but we can help anybody nationwide. And part of the reason I love doing webinars with Renika is you get the perspective of two different investment markets. So we'll talk a little bit about how you get to, as the bank, decide things like the terms, including things like interest rate and any points charged, and you're going to hear different perspectives from the different areas that we are located in and what we're seeing investors do. So I think that's a great way to sort of see what the markets are like in other areas. And we also attend a lot of networking events ourselves. And so when we do that, especially now during COVID, we've had the advantage of being able to join in different markets because of Zoom. And I also hear different things about what other investors are doing all over the country. So it's really been a great way to learn about different markets. And so again, Advanta has two offices. I'm in the Tampa Bay area, Renika's in Atlanta, but we can help anybody anywhere. And so if you have a US-based retirement, we even have clients that are outside of the US, as long as they have a US-based retirement account. So I think that's really important to know. And we have clients invested outside of the US. So we have clients invested in things like real estate in Costa Rica and in Switzerland. And again, just a lot of unique investment ideas. Then we've been helping with people with self-directed retirement accounts, HSAs and ESAs for almost 20 years. And we actually give everybody a personalized feel to their account. And even though you might not be local to one of our offices, a huge advantage is that you're going to have an account manager that comes along with your account and assists you for the life of the account. And what that means is you're not calling an 800 number and waiting for somebody to review your account, but instead you have somebody that is familiar with your account and they're assisting you and walking you through everything you need for that account. So that just sort of is what sets us apart from our competitors. So Renika, can you change the slide?
Yes.
Okay, so what is a self-directed IRA? And our definition of a self-directed IRA is something very specific. When you have a self-directed account with a brokerage firm, so Morgan Stanley, Fidelity, Charles Schwab, these are all really great providers, but what they do is help you with things inside of the market. And so they're going to help direct you into stocks, bonds, and mutual funds, all things that are publicly traded, whereas our definition of a self-directed IRA is much more specific in that you are directing your account into those assets that are considered private. And so we put together a little list for you here, but I just want you to be aware that this list is not a list of the only things that you can invest in. When it comes to a self-directed account, it's actually more like the sky's the limit with these accounts, and there's just very few things that you can't invest in and a few people that you can't transact with. But outside of that, you are free to go out there and find those investments that you know best for your retirement account and really determine the rate at which your IRA is going to grow. And on top of that, when you're looking at something like private lending, you really are choosing the rate at which your IRA is going to grow, right? Because you get to say, okay, well, I'm willing to accept 10% in 3 points. I only want to be in first position on a mortgage for real estate, things of that nature. Being the bank, you get to make all of those decisions. And so that's a great thing about private lending. But if you don't want to do private lending, there are so many other things we see clients investing in. So real estate, of course, real estate or real estate related assets like notes and mortgages are going to be the #1 investment we see at Advanta, but that actually only makes up for about 30% of the assets we hold. So outside of that, we see tax liens and of course auctions with tax deeds. We have seen people invest in farm animals, cattle, alpaca, racehorses. Again, the beauty of a self-directed retirement account is that you can simply invest in what you know best. So not everybody is invested in real estate. We see a lot of private equity investments, so things like limited partnerships, syndications, where maybe people are looking to make an investment into something that might be real estate, but they really want a passive investment. They're 100% hands off. They're making an investment based on a guaranteed return or a preferred return with that private equity. And going forward, they're going to rely on those general managers to make decisions on the investments. We also see things like precious metals, so it can be gold and silver, bars and coins. It can be platinum, palladium. There are so many different precious metals, and we definitely have seen an uptick in precious metals. Renika, are you getting a lot of calls on things like gold and silver?
Yes, I've had inquiries about cryptocurrency and definitely precious metals.
Yep, and that's a great point too. You can also invest in cryptocurrency, and absolutely, we have been getting a lot of calls on those. So I think, based on sort of where the market is right now, that generates interest in those types of assets, but also foreign currency exchange. It can be oil and gas. It could be equipment leasing. I've seen things like large format printers, ATM machines, and some other types of equipment leasing as well. Private lending, of course. And that private lending can be a note and a mortgage, or it could be unsecured. It could be a first position, second position, third position. It could be a wrap loan. So we will talk about all of those things coming up. Slide.
Okay, I do want to mention really quickly, I know Larissa talked about all the different events that we typically host. We actually have an event this Friday, is the Pitch, Promote, Prosper. And actually our speaker is going to be talking about oil and gas, like a niche strategy within the oil and gas. So definitely, if you're able to attend, go to our events page, go to the events page on our website to sign up for the Pitch, Promote, Prosper event. As for the different account types, Larissa mentioned, it's a universal list in terms of all of the things that's available to you when it comes to investing. As for the account types, the common IRAs or traditional IRAs and Roth IRAs, those can be self-directed. But also know that some lesser known accounts, like say an educational savings account that you can use to cover expenses for your children, education more so. If you have you can look to self-direct a health savings account to cover medical related expenses. If you're self-employed, you have several options, or you have a side business, you can self-direct a SEP, a simple, or a solo 401k. The solo 401k is very similar to a traditional 401k in terms of the flexibility and having the higher contribution limits. And then of course knowing that any former employer plan, any old 401k, 403b, TSP type plans, those can also be rolled over to be self-directed. You just want to, the key thing to remember is the different contribution limits, and we'll cover those limits on the next slide, but the different contribution limits between the account. And then with a Roth account, it is tax-free at retirement once you've reached retirement age and you've had that Roth account for at least 5 years. Also too, you have the ability, you can have multiple IRA accounts or multiple accounts, and you can actually partner those accounts together. We see a lot of clients typically take advantage of that strategy in terms of partnering their accounts. So if you're looking to make a contribution for a traditional or Roth, you can contribute up to $6,000 per year if you're under the age of 50. If you're over 50, you do have the additional $1,000 to catch up, so you can put $7,000 in a Roth or a traditional. If you, again, self-employed, the SEP, simple, and 401k is going to be specifically for you. With a SEP, you can contribute up to 25% of your earned income, and not to exceed $57,000. With a simple IRA, as the employee, you can contribute $13,500, and then the employer would actually can match you up to 3%. If you're over 50, you do have the additional catch-up, so you can add an additional $3,000 to a simple IRA. And then with the solo 401k, especially the month of December, we've seen a lot of clients inquire about opening up a solo 401k. It's specifically designed for self-employed, or you have a side business. So you can contribute up to $57,000 if you're under 50, or $63,000 if you're over 50. But you get to contribute twice, as the employee and the employer. If you have children, you can look to open up an ESA account, an educational savings account, to cover anything related to like tuitions or school supplies and books and so forth. But you can contribute $2,000 per year per child. Also, too, if you have family members, you can contribute to a child's ESA account as well. For an HSA, for an individual plan, you can contribute a little over $3,500. If you have a family HSA plan, you can contribute the $7,100 limit amount. But also, if you're over 55 for an HSA, you have the additional $1,000 as catch up. So when it comes to funding your account, you have several options. So you can make an annual contribution based on the limits that we just discussed that the IRS has set in place. Or if you have a former employer plan, you can do a rollover, like a direct or indirect rollover. In a rollover situation, you would actually initiate that request to get those funds moved over. We would tell you exactly how that check should be titled and then where the administrator should send that check. If you have an existing IRA, like Larissa mentioned, if you say have a brokerage account at Charles Schwab or Fidelity, with an IRA, you can transfer as much or as little as you need to in order to make that investment. It's not going to be any tax liabilities to you because you're moving from one qualified retirement account to the next. So you can use again contribution, rollover, or an IRA, transfer from an IRA, or a combination of all three.
So a few things you want to be aware of, and I mentioned them at the beginning of the webinar, is that although the list sort of goes on and on for a self-directed account, there are a few things that you can't invest in and a few people that you can't transact with. And so the two investment classes that you can't invest in through a self-directed account are going to be life insurance and collectibles. And so, of course, collectibles, sometimes people will say, well, what if I buy a gold coin? Then it's gold coin, but it might be collectible. Well, sort of the rule there is if you're making that investment, the value of the coin should be based on what the metal is trading at. If it has a value based on, it being something rare, then that's not going to work for your retirement account. So just be aware of that. And again, outside of these two asset classes, you really can make just about any investment. But you also want to make sure that you're abiding by the rules. The other thing that you need to be aware of is that the IRS has said that there are disqualified persons when it comes to transacting with your account. So who are those disqualified persons? Well, that's going to be yourself personally as the account holder, your spouse, your children, anybody up and down your lineal tree. So children, grandchildren, parents, grandparents, and then spouses or business entities of those. And the IRS goes one further and says that if there's a current benefit to you or any of these disqualified people, that it would be a prohibited transaction. So what does that look like? Well, ultimately, it's going to be something like, let's say I have money in my IRA and I lend it to my son. Well, even if I'm lending it at fair market, interest over terms, something that he would be able to get with a bank, it still would be considered prohibited because he is a disqualified person. So just make note of that. As long as you're making investments at arm's length transactions with third parties for investment purposes, it's very likely you can make those investments. And then another thing to be aware of is when the IRA, although rare, will expose itself to tax. So unrelated business income tax and unrelated debt finance income tax, those are two cases where you would expose your IRA to tax. The first one, although it is not prohibited, it is something that you will have to file a tax return and pay taxes on when you are running a business or receiving business income back to the retirement account. So I don't really have a good example of this for you just because it really sort of is left up to how the income is being received by the IRA and what type of investment that you're making. But if you are running a business or there are business earnings going back to the retirement account, this is where UBIT could potentially apply. Most investments are going to be considered something like, earning interest from a private loan or rental income from a piece of real estate owned by the IRA. Those are going to be things that are considered passive. But at what point does the investment you're making become a business? Well, the other type of tax here is unrelated debt financed income, which generates UBIT. not to confuse you, but if you purchase real estate with a loan, so you debt finance real estate in your retirement account, in your IRA very specifically, then that is going to also generate this tax. It does not apply in this one case of buying real estate with debt to a 401k, but it does apply to the IRA. So let's say that I buy a piece of real estate, I finance 50% of it, then what's going to happen is 50% of the income, because that's what's related to the debt, is going to be taxable, and it's at trust tax rates. The one good thing, of course, is that the IRA is going to get deductions. You want to check with your CPA on this. But the trust tax rates are high. So usually we tell people, have a CPA help you with calculations, see if it makes sense. Another time that this might apply is if you're making private equity investments and that private equity is buying with debt. So you want to find out from them, have them help you understand how UBIT or UDFI works and whether or not it will apply based on what their investment strategy is. And again, that does not apply if you're using a 401k. So just a little bit different between the two types of account. So here again is an illustration for you of who is considered disqualified with the IRA and 401k, ESA and HSA accounts. So it's the IRA holder themselves personally, their spouse, parents, grandparents, children, grandchildren, and spouses or business entities of those. And that's important because sometimes people will say, well, I'm not lending money to my son, I'm lending it to his business. Unfortunately, that is still considered prohibited. So you want to be aware and really sort of memorize this chart or reach out to us with questions, but make sure that you're doing business or investing with third parties, so people unrelated to you. And we also mentioned very briefly about a current benefit. So an example of that would be, if you were buying a condo on the beach and you were renting it even, to either third parties, or you put it into a rental pool and it's completely hands off, you're not handling it at all, and your IRA is going to receive income, that's completely fine. But in addition to that, if the condo comes with a dock and now you're going to use that dock for your personal boat, that is where that current benefit rule would come in and make that transaction prohibited. So again, just being aware of the rules, giving us a call and asking us those questions. Hey, this is what I'm thinking about. Can you give me some guidance here? And we'll help you understand the rules and how your investment plan might work within the rules or maybe be prohibited. Slide.
Okay, so Larissa covered the few things that you can't do, the few restrictions or the few things that you can't do in your IRA. I do want to kind of pivot and talk about all of the things that you can do in a private lending scenario in terms of the types of private lending options. So your IRA, it does have a lot of leeway in terms of the terms and the ability to make loans and actually what those terms will look like. And this is actually where you get to, control, the growth that your IRA can experience. So your IRA can provide, say, bridge funding or transactional loans on a short-term basis. And that can be anywhere from, say, a 3 months, 6 months, or even sometime up to a year turnaround time for short-term funding. We have clients here at Advanta that actually use the IRA to maybe to more so act as lenders on the more traditional mortgage loans, and that can range from the standard 15 to 30-year time frame. Your IRA can originate loans in an origination scenario, meaning that you would have to go out and find the person. With any investment, you always want to do your due diligence, make sure you thoroughly vet the borrower to make sure that they're suitable. And then, of course, you get to set the terms, agree upon the terms, set the terms, and then generate that note. If you're not looking to originate a loan, your IRA can certainly buy existing notes. You can buy it from, say, a broker or another investor, or, again, part of your networking. If it's someone in your local REIA group, they may be a note broker or a note investor. That note itself can be a whole or fractional note. If it's fractional, it just simply means that you're pooling funds to buy a portion of, say, a much larger note, like an industrial space or some other commercial building, like, say, an office facility. With notes, it can be a performing note or a non-performing note. With non-performing notes, a lot of investors like non-performing just because there's a greater potential for return in terms of deeper discounts. If it is a non-performing note, though, again, you want to You want to do your due diligence, but you'll have to go back to the borrower to renegotiate the terms to get that note performing again, so you can get that income flowing into your IRA. Another option for private lending or notes, it can be a secured note or unsecured note. The IRS doesn't have any restrictions in regards to that, so both are options for you. If it's a secured note, then there is collateral attached to the deal. If the borrower ever default, at least you have something to protect your interest or protect your IRA's interest in securing that note. If it's an unsecured note, again, it's extremely important that you understand the risk associated with an unsecured note. Typically, we usually see higher interest returns with unsecured notes just because there's greater risk involved. But at Advanta, as the administrator, as the custodian for the IRA, with an unsecured note, we will need the actual original promissory note agreement, and that note agreement is kind of outline everything relating to that investment. Your IRA can do an equity participation option, like a joint venture partnership, and that's where your IRA is going to be able to participate both, with interest returns and also receive part of the profits. A lot of times, investors want, part of the upside in the actual deal. We'll cover some case studies, one of which will include an equity participation deal. And I do want to do a friendly reminder, like Larissa mentioned. Again, you can do loans absolutely, but you just can't do a loan to a disqualified person. And then even if you do other types of loans with non-disqualified person, you still want to make sure that the loan is a fair market value to your IRA. So for example, you don't want to make a loan at 0% or 1%, because at that point your IRA is not really benefiting from that type of deal.
And before you go on, Renika, I did have a question about Dodd-Frank pop-up that I wanted to address really quickly. That's really a great question. For those of you that are not aware, Dodd-Frank is sort of in place to protect consumers. So if you were lending to somebody who was going to live in that property, you're going to have a mortgage on that property, you definitely want to get an attorney involved that can help you. The rules for Dodd-Frank are going to apply just like they do to any loan. So that is definitely something that I would suggest getting an attorney involved in. So you may or may not be required to have a mortgage broker involved. If you're lending to the person that is going to live in the property, a lot of times we'll see loans to things like businesses, for example, or to an investor who's going to use the property for renting it. So they're not going to be living in the property. But still, if you have questions on how that might, how Dodd-Frank might impact that, you would really need to get an attorney involved, because we can't give you advice on that. But I appreciate the question. And if anybody needs an attorney, we could certainly refer you to attorneys that could assist you with that.
Okay, yes, a great question. Always confer with your professional team, especially when it comes to drafting note agreements and making sure everything is outlined in that agreement. In terms of establishing the terms, there's several things that you want to look at when setting the terms for your investment. Just like your normal bank would, you're going to be looking at what is the amount that's going to be borrowed? How much are you willing to lend? This is really where you get to, again, control the growth rate that you want your IRA to experience. So again, what is the amount that's going to be borrowed? You're going to be thinking about the interest rate. What is the expected return to your IRA? Are you going to be doing a note agreement that's 5%, 8%, 10%, 12%, or something else? Again, you get to decide what works best for your IRA. You want to look at the length of terms. Are you going to do gap funding? Is it a short 6 months bridge loan, or is it going to be the traditional 30-year mortgage loan? You'll decide, okay, if it's an equity participation in terms of you getting part of the upside of that deal, you want to just make sure that's included in a note agreement as well. You also too want to highlight, make sure it's very, very clear that the payment due date and the delivery address is outlined in that agreement, just so you can have those payments come back to your IRA or if you're going to hire a loan servicing company to help with managing that loan. Anytime money is deposited into your account, you will get an email notification from us, but also too, you have access to an online portal, so you can log in at any time to view your statements or track your account. Larissa, is there anything else you want to add to the terms?
No, I think, and you sort of touched on this a little bit, is if you need a loan servicer, that's going to be something that you determine, but just know that Advanta IRA is not checking to make sure that your payments have been received in a timely manner. So as the IRA holder, and again, it is a self-directed account, you want to make sure that if your payments are due on the 1st with a late fee by the 5th, or whatever your terms might have been, that you are getting those payments when you expect them to come in. You'll get an email notification. You can check online, as Renika said. But ultimately, if you don't want to be responsible for making sure that your borrower is paying on time and that the late fee is being paid when it should be paid, then you could definitely look at a loan servicing company that will help you with that. And so that way your investment is truly hands off. Now, if you feel like I'm capable of making sure it's on time, I know what to do if I need to. If there's a late payment, I'm comfortable reaching out to the borrower. If anything needs to be done, then you certainly could do that and handle it yourself. But if you want recommendations or referrals to loan servicing companies, we probably have a few that we could share with you, certainly we can find out if there's any local to you, if of course they're not local. So that's just something I want everybody to keep in mind, because a lot of times people say, well, you'll alert us if the borrower isn't paying, right? And we don't. We do alert you when they are paying in the form of an email when the deposit hits your account. But outside of that, as a self-directed IRA holder, it is going to be up to you to make sure that the account is operating as you expect it to.
Thank you. And then also too, for and late payment provisions, you want to make sure also in that agreement that you include, how are you going to get access to collateral if the borrower ever defaults? If you have to foreclose, you want to be able to know that you can get access of that collateral or take possession as needed. So we looked at the different types in terms of the types of notes. We've looked at how you can actually set the terms or create the terms that works best for your IRA, so you can really control the rate of return. I do just want to highlight just really quickly some of the benefits. This is not limited to, but this is just some of the general benefits that private lending provides. So again, you know exactly the rate that your IRA is going to get because it's outlined in the note agreement. It's something that you, as the account holder, decide that, okay, it's suitable for your IRA. A lot of investors prefer making private lending, private lending loans or loans or notes, just because as opposed to maybe holding the real estate directly, they feel that it's less liability for them. So it's no right or wrong. It's just based on your preferred investment strategy. But oftentimes we see investors like to just lend on property as opposed to holding it directly. Another benefit, it can be a very attractive investment in terms of if you find a borrower and they're good at repaying the loan on time, the maintenance for that can be very low, very passive, again, making it a very attractive investment. Oftentimes, you do see lenders working with a particular borrower on a recurring basis just because they've established that rapport, they have a good relationship, and the borrower's good at repaying, so it works best for everyone involved. I know for me as an investor, I've done notes with a particular person multiple times just because, again, we've established that mutually beneficial relationship that works for my IRA and the borrower. And then a final benefit, we talked briefly about the ability to partner, but your IRA can participate in ways which includes partnering funds. So you can look to partner with other individuals, you can look to partner with other IRA holders, or again, if you have multiple IRAs, you can partner those accounts together. So for instance, with an HSA or an ESA, and you have a traditional solo 401k, with an HSA for a single person, you could only put in $3,500. But if you're able to, partner that HSA with, your solo 401k and, actively do deals, you can grow that account pretty considerably. So we're going to transition and look at a couple of case studies. Just know that the numbers are just illustration purposes. It's nothing specific to any of our investors or our clients, but it's just more so for a guide.
Exactly, and we're going to start in this first case study with just a first position mortgage, something that would be considered, pretty common with a self-directed IRA, something we see on a regular basis at Advanta. But again, remember that it could be a second mortgage, a third mortgage. We're going to leave it up to you as the account holder to determine what you're comfortable with. So when you're lending, doing your due diligence is going to be very important, and we're going to talk about that in just a minute. So in this case study, first mortgage, Paul has $120,000 in an IRA and he wants to have more consistent returns. Remember, when we talked about private lending, the great thing about private lending in a retirement account is you really determine the rate at which your IRA is going to grow. So, Paul is okay with an 8% interest rate with a 5-year balloon. So, those are the terms he agrees on with the borrower. But if he wanted 10%, a few points, if he wanted it to be amortizing instead of interest only, as the bank, he's going to make all of those decisions. So if you go to a bank, you guys know when you're borrowing to buy a property, the bank is going to say, well, we're willing to lend you this much. You have to come to the table with X amount of dollars. We're willing to lend it at an interest rate of X. We want to have regular payments. The terms are going to be, 30-year terms or 15-year terms or whatever it's going to be. And before lending you this money, we want to do our due diligence, and we need information from you in order to determine whether or not we're willing to lend this money. So you're very familiar with that process, and now you as the bank can make those decisions and say, hey, Mr. or Mrs. Borrower, this is what I'm willing to do, and these are the terms that I'm willing to agree to if and when. So you get to do all of those things. And so, in this example, Paul vets the property and the borrower. Again, remembering that it's up to you to do your due diligence. We're not going to say, yes, this sounds like a good investment, or no, it doesn't sound like a good investment. So it's going to be up to you to vet the borrower, vet the property, and make sure that you're comfortable with the investment. So he looks at the property. He wants to make sure that if he should have to foreclose, he's going to recoup some or all of his investment by owning that property. In this case, he's in first position. So if the borrower doesn't pay, he could foreclose and take the property back instead of payment. And he's also going to look at the borrower. So the borrower in this case, is it a rehab property? Is it a buy and hold for rental purposes? Maybe it is something the borrower is going to live in. And then again, having the possibility of Dodd-Frank. So there's a lot to look at potentially when you're making these investments. The loan amount in this case is $120,000. The interest rate agreed upon is 8%. It's a 5-year balloon with payments monthly at $800. Sorry guys, I skipped slides a little bit here. Thanks, Renika. So it's secured by a first mortgage on the property. So in this case, Paul feels that his security is very good. He's in first position. He probably said, okay, what is this property valued at? He has to look at the values of the property surrounding it in the surrounding area and make sure he agrees with the value. But maybe he says, I only lend at 80% of the value of the property, or maybe he's willing to lend at 100%. Again, as the IRA holder, it's going to be completely up to Paul. So how does this process work? Well, first, Paul's going to open and fund his IRA account. That's very important because the IRS requires you to have a third-party administrator like Advanta hold your IRA account prior to making an investment that would be considered self-directed. So the IRS doesn't say, okay, well, you can go open a bank account, call it an IRA, and you're all set to go. That is prohibited. So you would open an account with Advanta. We help you transfer or roll funds into this account. From there, Paul's going to let us know, okay, this is the investment I'm making. And from there, we're going to say, okay, well, we need to see the note and the mortgage. We want to make sure that the borrower, the lender in this case is Paul's IRA. So we're going to look at the documents for that. We do not provide the legal documents. So the note and mortgage are prepared by the title company or the closing attorney or maybe Paul's personal attorney, whoever it may be, but Advanta does not do that. We will review those documents though and say, okay, the lender should be here, the signer is here, whatever it is that encompasses that investment, we're going to check to make sure that the IRA is properly represented. And of course, in this case, the IRA doesn't need to sign anything, but we do have Paul sign because we want to make sure that he's reviewed the terms of the note and mortgage or deed of trust, whatever it might be, and that he agrees to that. So we want to make sure that he has reviewed it. So we're going to have him sign it and say, yep, this is the investment I want to make. Once we have his signature, we can fund the investment. So he's going to review and approve all the documents. We are going to find out what the closing date is. Once we have Paul's approval, we'll send the money out, and the mortgage and possibly the note are recorded showing the IRA, Advanta IRA, FBO Paul as the lender. So what happens after close? Well, the borrower sends monthly interest-only payments to Advanta. Alternately, Paul might have a loan servicing company, so then the payments would go to that company, and then the company would forward payments on to Advanta IRA. The borrower can also send the payment directly to Paul. However, the check needs to be made payable to the IRA. So if Paul is checking his ledger, making a check mark when he receives the payment, recording the date, he could certainly do that, but then the check needs to be forwarded on to Advanta. It cannot be made in Paul's personal name because he cannot then turn and make a check to Advanta from his personal checking account. That would be prohibited. So it's very important that the IRA receives the income and pays the expenses directly. Paul, as the account holder, cannot provide that service to his IRA. And he can track his monthly payments, as we discussed, online using statements. He'll also receive his emails letting him know when the checks have been received and deposited. When the borrower decides to sell the house, and Paul's IRA will receive that $120,000, remember this was an interest-only note. Over the course of the 3 years, Paul's IRA made $28,800 in interest payments for the life of the loan. Paul's interest payments go back to the IRA with no capital gains, and depending on the type of account that Paul has, the IRA may be tax deferred, traditional IRA, or it might be tax free, and so those gains are going to be subject to the type of account he has. So they're either tax deferred, and upon retirement age and distribution, they would be considered taxed at ordinary income, or they could be tax free if it's a Roth IRA upon holding of the account for 5 years and reaching the age of retirement.
Okay, so in case study number 2, we're going to look at a loan with equity participation. So in this case, again, with equity participation, you get to participate. Well, you get to get into your IRA, get interest return, but also too, you get to take part in part of the profits of that investment. So in this scenario, we have Andrea. She knows she wants to invest in real estate, but she doesn't want to do a flip herself. So she's looking to do a joint venture partnership. It's Andrea's responsibility to go out and find someone she's willing to JV with. In her case, she's part of a local RIA group. She has an extensive network of other investors. So she has $150,000 in her IRA, and she decides, okay, fix and flip is what she wants to partake in or JV on. So she meets Steve at her local RIA group. Again, and she's responsible for making sure that she does her due diligence on Steve. Maybe looking at some of his previous works, or asking around about maybe some partnerships he's done in the past. She has to be comfortable that this is the right decision for her. Steve, he's an active fix and flipper. He understands Andrea's concerns or inquiries, and he shows her that he has skin in the game by putting the property up as collateral, and also too putting some of his own money in the deal as the down payment, just to kind of show her that hey, he has skin in the game when it comes to the JV opportunities. So ultimately, she does decide to do the deal with him. She's going to lend him the rest. Well, her IRA is going to lend him the rest of the money to purchase the property and fix rehab and get ready to put on the market. So in terms of the terms for this actual agreement, again, when you're self-directing, when you're being the bank, you get to decide the terms that works best for your IRA. So the loan amount would be $125,000 coming from Andrea's IRA. They agreed to do an interest rate of 5%. Normally, you would see a lower interest rate when there's equity participation just because you're getting interest return and part of the profits. So they came to an agreement at 5%, and then with the profit split, she's going to get her IRA is going to get a third of the profits with a 2-year below note. With monthly payments of $520 a month. He's going to hold the property for a couple of months, fix it up. So during that time, her IRA is going to receive monthly payments of $520. And again, she's in first position. She wants to make sure her IRA's interest is protected. So she's in first mortgage position in case if there's a default situation, she can take possession of that. Her IRA can take possession of that property. It's Andrew's responsibility to, again, confer with her professional team, like her attorney, to help her go through and draw up the paperwork for the note mortgage. Ultimately, nothing happens until she says it does. So she does have to, read and approve. She'll work with her assigned account manager here at Advanta, reading, approving, giving her consent on all of the documents. Once she does that, Advanta will then, send the money from her IRA account over to Steve to purchase the property and make the investment. Advanta also, as the administrator, will hold the actual note on behalf of Andrea's IRA. And then in the end, after the property's fixed up and it's time to sell, Steve he's ready to sell the property for $200,000. He goes to Andrea to request the payoff amount. So Andrea, she's acting as a loan servicer, so she provides the payoff letter. Or if you do have a service provider, they'll draft up that payoff letter, and then of course it's going to be sent to the title and company that's handling the closing on the property. So in terms of the actual earnings and the return, both parties are happy with the outcome. Andrea's IRA, she got the $125,000 back in principal. So again, her principal is secured, but also too during that time, at 5 or 6 month time frame, her IRA also received interest payments of $3,000, as well as she negotiated that she wanted part of the profits from that deal. In this case, a third of the profits, netting her IRA $25,000 from the profits with a total earning of $28,000. So from Andrea's standpoint, as an investor, she's thinking, okay, how can I replicate this? How can I duplicate that effort? And oftentimes we see, investors JV on deals on a continual basis. Steve is also very happy with the earnings. Again, he was able to pay the original loan back of $125,000. He was able to get a really good deal for the property in terms of selling. He fixed it up, fixed up the property, and was able to sell it for $200,000 after servicing his loan, the interest, and the profits to Andrea's IRA. He actually also ended up with $47,000. So for Steve, he's quite content, quite happy with the outcome. Both can look to possibly partner on another deal or move on to their next respective project. So the first two scenarios, the first two case studies, both actually used real estate as the collateral. But I do want to mention that the collateral itself does not have to be real estate based. Normally, it's the preferred option just because we know real estate is a tangible asset; it always holds some value. But you can use other items as well. Typically, a loan can be collateralized, even well, not typical, but a loan can be collateralized using a collectible item, like say a coin collection, or if you have a watch collection. It can become problematic or challenging if, for instance, the borrower defaults, and then you have to foreclose and try to take possession, simply because the IRA is not allowed to hold a prohibited item like a coin collection or watch collection. So you're going to have to look at different options like, hey, do I need to, sell this non-performing note? Will you have to liquidate or cash out, just so the IRA doesn't end up owning something that's considered prohibited, like a collectible item. You also want to, look at if it's a company stock that's being used as collateral. Is it easy to sell those company shares? You want to be able to find out what kind of tax status the company has. I know Larissa touched on it briefly, but you want to know what type of status that company has, and also too, is it an S corporation? Specifically, S corporation doesn't allow IRA as shareholders. So that's very important that you find that out during the initial process. So it's imperative to do your proper due diligence. You want to be thinking about these things ahead of time, just so you know what kind of collateral is being used before you actually make the loan from your IRA. And two, making sure that collateral is in a place where you can take possession of it or get access of it if there is a default situation. Typically, we see, again, most time it's real estate being used as collateral, but if it's a non-real estate related collateral, then consult with your attorney because you want to make sure that your IRA is protected. You want to make sure that you have some type of documentation on file on public record to show that your IRA can potentially put a lien against that collateral if there is a default situation.
And that's a really great point because we had a question pop up about using an attorney to draw up your contracts and things of that nature. Is that an advantage? And I would say that that certainly is always an advantage to you to have someone on your professional team assisting you with any legal documents. Advanta IRA does not require that you use an attorney, but I definitely think that having somebody look over something for you that is well versed in those types of investments, that has done this a time or two, it's always an advantage to have those people that would be considered professionals in that area to have them assist you with those documents. So again, not required by Advanta, but I do think it's always an advantage to have somebody assist you. If you had a note and mortgage that you wanted to use that you had lying around, so to speak, and you use that document for this investment and you find, well, it was missing this or missing that down the line, that might make it difficult for you to either foreclose or collect payments or things of that nature. So having somebody assist you with that is always a good idea. We had another question pop up too about expenses to obtain the note, for example, marketing lists and mailings, postage, things of that. Should that be paid out of the IRA? All expenses should be paid by the IRA for any investment that you're making. However, I think the question being asked, if you would reach out to either me or Renika, we could go over that in more detail with you, because I also think that you should possibly be careful about marketing for investments for your IRA. This might be a gray area and also might lend to the possibility of running a business here and also providing services to your IRA, which you really don't want to do. So if you would reach out to us, either myself or Renika, we can go over this with you in more detail. But thank you for the question. And again, just being careful with that and remembering that expenses should always be paid by the IRA for IRA related investments. So the next case study we're going to do here is unsecured lending. And I know a lot of times people will say to us, well, I'm definitely not comfortable with loaning money unsecured. I'm just unwilling to do that. And that is absolutely up to you as the IRA holder. Something to keep in mind is that there are people out there willing to lend unsecured, and we do have a large number of unsecured loans held by Advanta for benefit of our clients. One possible reason is that a lot of times you'll see unsecured notes to companies rather than to individuals. Another thing, of course, is the greater the risk, the greater the reward. So you're typically seeing unsecured notes at higher interest rates for shorter terms. So that's another thing as well. But also that our clients doing unsecured notes are very familiar with their options should their borrower not pay. So keeping all of this in mind when you're making those investments. Slide. Okay, so in this example, Tom has $50,000 in a SEP IRA. He has a friend who wants to expand his business and needs short-term capital. So Tom decides that he's okay lending his IRA money without collateral. And so Tom drafts the unsecured promissory note listing his IRA as the lender. In this example, the loan amount is $50,000 with 10% interest and 1-year balloon note with a lump sum payment of $55,000 after that 1 year. And, that's really important because The idea there being that, you know, the IRS doesn't say, well, you have to receive monthly payments or you have to receive quarterly payments for your investments through a self-directed IRA. So this way, in this example, Tom simply outlines that he's okay with a lump sum payment at the end of the agreed upon term. Now, if they get to that 1 year and Tom's friend says, well, I'd like to extend the terms, can we do that? And Tom agrees, then yes, absolutely. They would draft an amendment to the note. They would make the changes that they agree upon, and we would just simply hold it for Tom's reference later on. But again, that's between the borrower and the lender. Advanta IRA isn't going to make any determination for you. So if you come to us and say, okay, I'm willing to extend, then we're going to say, okay, please draft the document or have your attorney draft the document that says you're extending the terms of the note. Because there's no title company involved in this transaction, again, remember it's unsecured, so there's no security at all, including real estate. So Advanta must have the original note in our possession before funding. We want that originally signed note. That means that we are going to safekeep it for you, and that's important because when we are doing a loan through a title company with real estate, the title company is acting as that third party to hold the money for that transaction. And so it's okay for the money to go to the title company and then for them to close on the real estate transaction. And then eventually they are responsible for making sure we receive the original note and mortgage, and that it's also recorded, because none of those things will be happening in this transaction. There will be the opportunity for the borrower to sign the note and then, you know, FedEx it, drop it off at one of our offices, mail it to us, whatever it might be, prior to funding. And so a lot of times we're asked to do deals very quickly, and we certainly can do that, but it's all going to be based around whether or not you as the IRA holder and whether or not your borrower can get the paperwork done quickly enough to meet your deadline. So we're reviewing the paperwork and we can do that quickly as well, but we're relying on you to complete the purchase authorization form that we have outlining the details of the investment, signing the note read and approved in this example, and then having your borrower send us the originally signed note. And if all of those things can get done, we can certainly fund in 24 or 48 hours. It is a cash transaction after all. Of course, unsecured lending is going to be more, a lot more risky, because you have in a conventional note and mortgage situation the ability to foreclose should your borrower not pay. So what will you do if an unsecured note goes bad? How does that work? Well, you will definitely want to consult an attorney, or as Renika says, a person on your professional team that can help you understand what recourse, if any, you have if you have a borrower default on an unsecured note.
Okay, so I did see a comment come in terms of the equity participation deal with Andrea and Steve. The comment was that Steve put down 20% to reduce the amount of profit. So the numbers is just more so for illustration. Steve did put down some money and also put the property up as collateral. We didn't specify the amount, but also too, it's Andrea's responsibility as the lender to feel comfortable in terms of how much she's willing to lend. So maybe she did require that Steve put 20% down, but the numbers are just more so for illustration purposes. In terms of getting, go ahead, I'm sorry.
No, that's okay. We hear, you know, people say that all the time. I mean, I see private money lenders willing to lend 100% of the property value, but 0% of the rehab if there's any rehab involved. Or we see, you know, somebody willing to lend 80% of the property value, and it's going to be a buy and hold, and you know the borrower is going to hold that property and rent it out, or whatever it might be. And so you are certainly going to make those decisions as the IRA holder.
Exactly. So in terms of getting started with us, we've talked about some of the different private lending options. We talked about the different account types, but we've really at Advanta streamlined that process for you when you're ready to get started, to make it as simple as possible for you. And it's 3 simple steps. First and foremost, you go through the process of opening your account by completing the application. That could be done electronically. Larissa and I were on the front end, so we can assist you with the initial account opening process. But just know that once your account is open, you will have a dedicated account manager. We take great pride in providing our clients that concierge style service. And then, of course, your account manager is there to help you, guide you throughout the life of your account with us. Step 2 is funding the account. You have several options. Are you going to roll funds over from, from an employer plan like a 401k or 403b or TSP, or, are you going to transfer from an existing IRA? Again, it's not end all be all. You get to decide how much you need to move over, transfer over to make your investment. Or are you going to, make an annual contribution, or use a combination of all three? And then finally, start investing. What's your preferred investment strategy? If you want to be the bank where you get to control the type of growth that your IRA can get back that's suitable for you, you get to decide what works best for you in terms of, type of notes, whether it's, secured or unsecured. Like Larissa mentioned, it's, a lot of risk involved with unsecured, but you get to decide the type of returns that's going to work for your IRA.
So here's our contact information. Again, we encourage you to reach out to us if you have any questions that you didn't ask during the webinar. And we have just a minute left here, so if you wanted to put any last minute questions in the question box, go ahead and do that. Reach out to either Ronika or myself. And if you'd like a copy of the slides, please do reach out to us. The system does not allow us to attach the slides in the email that will go out today or tomorrow with the recording for this webinar. So if you would like them, please send us an email. We'll make sure you get the slides, and you can, with the recording, you can review it, or you can certainly share it as well. It'll also be posted to our YouTube channel along with all of our other great education that we do weekly here at Advanta. Ronika also did mention that we have a networking event coming up on Friday. She'll be hosting it with our colleague Clay, and that networking event is a great opportunity to, again, see what people are doing in different markets. So we have people join nationwide. Everybody that joins will have the opportunity to introduce themselves and either pitch an investment, talk about what they're looking for, talk about what they have, or talk about services that they provide. So everybody does have that opportunity. You do not have to speak if you choose not to, but it is a great way to find out what is going on across the country in different markets and see what other investors as yourselves are doing out there with self-directed accounts and beyond. So we have really enjoyed putting this event on. We have been lucky enough to have anywhere from 35 to 100 people online with us. And so the other thing is that you want to make sure that you're registering for that event. So you're going to go to advantaira.com/events and click on Pitch, Promote, and Prosper. Register for the event. Once you register, you will receive an email with a link to join. So unfortunately, we cannot just provide the link to join on our website. We are unable to do that. So we do have to have you register, but once you register, you will receive the link to join on Friday. It's 12 o'clock Eastern Standard Time, so be aware of the time. And when you join, we'll give everybody the opportunity to speak. And then we also have the presenter that Ronika mentioned, and he'll be talking about oil and gas investments, and he is very well versed on self-directed IRAs. He has started up. And Ronika, tell me that the name of his organization again. Is it the Self-Directed IRA Network?
Yeah, so Brian Ellis, he actually, he's the, I want to make sure, he has a self-directed publication. I'm sorry, I was wanting to make sure I provide the contact information. I'm typing something. But yes, he has a self-directed IRA investor publication, but he's going to be our featured speaker on Friday.
Okay, great. And so you'll have the opportunity to introduce yourself, but then also ask questions of the speaker. So it will be a great interactive discussion that we'll have, and we try to always promote discussion during those networking events, and we'd love to have you join us. If you can't make it this Friday, they are every other Friday, so just make a note in your calendar. They are every other Friday, and I believe that we ended up being able to continue them that way. So, but they will be posted to our calendar as well as we move forward and sort of skip around the holidays here in the next couple of weeks. So again, we'd like to thank everybody for joining us. We really enjoy having people on and being able to share the recording later on. And we have so many great events coming up in our calendar all the way through January and February. I know both Ronika and myself have a lot of great events. So thank you again for joining us, and please check out our events calendar for anything upcoming. Take care, Ronika.
Thank you. Bye, everyone.